Hi, I'm Greg Hunter. Welcome to USAWatchdog.com. With us once again, a guy that predicted back in 2013 that it'll be game over in 2014. And boy, the statistics sure look like it's game over. I'm talking about John Williams at shadowstats.com. John Williams coming to us from California. Thank you for joining us today.
Thank you for having me, Greg.
And, of course, shadowstats.com, for whoever is a beginner, you take the raw numbers and without all the accounting gimmicks, and you come up with real statistics. And you said that 14 was going to be bad and that you couldn't see how that the second quarter was going to be good. And I want to start with your chart because they say a picture's worth 1,000 words. And this is one of your charts that you've come up with. You've taken out all the garbage and shown what the real economy is looking like. And if you take a look at this chart, you can see right here, this band right here that's around 2008, 2007, this peak here, and then 2008 to 2009, this crash. And one of the things that you've been saying for a long time is that we've been bottom bouncing. If you look what's been going on since 2009, bottom bouncing, not this recovery that they keep telling us we have, that we have this big line here going down, which is our most recent line, but really what we're having is bottom bouncing, but now this line here, and I just want to bring this into focus, it's crashing again. And I want you to talk about, that you said that second quarter is going to be negative. We don't have the numbers yet, but second quarter is going to be negative. Could you please explain this chart and what's going to be happening when the numbers for the second quarter, it's over, when they do come out?
I'm looking for them to be negative. A lot of it's in place right now. It'll be reported on July 30th. And if the consensus has not moved into negative territory, which looks increasingly unlikely at this point, they could bring it in as a small plus and then take it negative in revision. That's the way the Bureau of Economic Analysis tends to do that. But if you look at the official reporting, unlike my graph, the government does show the economy plunging, but then recovering. Mine keeps bottom bouncing. The difference there very simply is that the government underestimates the inflation that it uses in calculating the inflation adjusted number here. And normally, where my numbers go up and down there, the government's numbers generally continue to rise and rise and rise. The fact that we saw a 2.9% contraction in the first quarter in official reporting, and that's the first time we've had a negative quarter reported at the time by the government outside of the official recession. The economy's in real bad shape. It's continued to the second quarter. That'll gain recognition in the next month or two as all the data get published.
And what you're saying that the country, that the economy's in bad shape. You're saying that that's the best they can make it look. And if you look at the fourth quarter of 13, and I'm so glad that Paul Craig Roberts came out with an article that pointed this out too. I thought, wow, I'm in good company. But, it was 2.6%. The fourth quarter, that's the official number of 2013. And the first quarter, negative 2.9. That's a 5.5% cliff dive into a pool with about an inch of water. I mean, that's a pretty big plunge. And now you're saying, and back in 2013, you were saying it's going to be game over in 2014. And the statistics on your end, are they showing that the game is winding down?
Well, it's showing that the economy is continuing to weaken. It never recovered. So that we're a second quarter contraction here almost assuredly would be recognized as a new recession. I'll contend we never got out of the old recession. It was again plunge, stagnation, and now we're turning down anew.
Well, surely the Federal Reserve, a lot of people say, they're stupid, they don't know what they're doing. I don't think so. I think they know what you know. I think there at least some people there know what you know. So surely they know that the economy is not doing well, and the second quarter, when the numbers come out, are going to be not good. And so my question to you is, this came out last week, and I'll just show you this headline here, and it says, this came out in the Fed Minutes in June, and said that, the Fed's going to end their bond buying program in October. And I'm thinking, if they know that this chart in reality looks like this, bottom bouncing and plowing, this big plunge coming on. How are they going to stop their bond buying? I mean, they're going to put our debt out to at par for people to bid on. Interest rates would skyrocket.
Well, I expect the Fed's always going to be there to buy it, and I looked at their announcement as well. The October end is preconditioned on the economy continuing to show positive economic results as the Fed expects. That's not going to happen. The easings that we've seen by the Fed have been aimed at propping up the banking system, providing liquidity for the banking system, not just stimulating the economy. Former Fed Chairman Bernanke admitted that the Fed was at a point there was very little they could do to stimulate the economy. The problem is keeping the banking system afloat. A weaker than expected economy, and we're looking at something much weaker than expected, means the banking system is going to be under further stress. It hasn't recovered since the crisis of 2008, since the panic of 2008. And so the Fed will want to continue to provide liquidity. The problem is that's not politically popular. So what they've been using is the weak economy as political cover for basically continuing to bail out the banking system. And that's going to continue. So I'd be surprised if the tapering actually comes to an end in October.
So you think after the numbers officially come out, and they know the real numbers behind the revisions already, they have hundreds of economists at the Federal Reserve. Come on. And you're saying after the second quarter, plunges, and I mean 2.9% negative print. Even if they get 3%, that's only 0.1% growth between the two quarters. I mean the first quarter of 2014 and the second quarter. They need, if they've been advertising, it's going to be 3 or 4%. Well, they need a 7 or 8% growth to get that number, don't they? I mean, they're not going to get it, are they?
No, the expectation seems to be in the 2 to 3% range. If it were 3%, you'd just recover the level you had in the fourth quarter. Initial reporting could be slightly on the positive side. If the consensus hasn't turned negative, the Bureau of Economic Analysis will try to keep the number in positive territory so as to minimize the shock on the markets. But the results are going to be a lot weaker than expected, and it should very quickly turn to the downside in revision, if not in initial reporting.
So let's say we get these two quarters back to back, which it looks like we're going to get pretty negative. What happens to the tax receipts? What happens to the federal budget? What happens to the U.S. economy? Are foreigners going to look at this like, oh, America's in trouble, sell, sell, sell?
Well, you have a lot of things that are dependent on the economic activity, including the budget deficit. Weaker than expected economy means the budget deficit's going to be worse than expected. Weaker than expected economy will also tend to trigger selling pressure against the dollar. I'm still looking for a massive decline in the U.S. dollar, and a renewed recession certainly could be a trigger for that.
And now you have stated that there's at least 16 trillion liquid U.S. dollar assets. A lot of people held outside the country. A lot of people don't really quite grasp what that means. I mean, that's the entire U.S. GDP held in cash or cash-type instruments held outside the country. When you start talking about, a dollar crash, you explain what that means.
Well, as the dollar crashes, and a number of reasons for that to happen, a confluence of factors beyond a weak economy, ongoing problems with Fed policy concerns over the long-term solvency issues of the United States, political stability in the United States. A very good indicator and predictor of dollar activity is the popularity rating of the president. When that's low, usually the dollar's under selling pressure. You put all these factors together. In fact, we've been through panics and dollar crises where the rest of the world has been holding the dollars, waiting for the U.S. to get its house into order, and it's clear now that we're not going to do so. With all the budget deals we've had, no one's looking to address the long-term solvency of the U.S. government, at least no one who's got the clout to get it through at this point. So the rest of the world is in a position basically to get out of the dollar. And once someone starts moving, you'll have a flood of people leaving. You'll see it'll tend to trigger very high inflation here. So dollar weakens, for example, you'll see higher oil prices.
In dollar terms. Everything in dollar terms, boom, goes up.
Yeah. You'll also see mounting pressure, which is already there, to have the dollar removed as a world reserve currency. And that would accelerate the domestic inflation. And I'm still looking for a near-term hyperinflation. It's dependent in the near term of in a very heavy decline in the U.S. dollar. That would be the proximal trigger, but I still have that in place.
So you think that foreigners will just say, "I'm done. We don't need the dollar." I mean, you've heard France saying, maybe we don't need to trade oil and dollar. Big oil companies, foreign oil companies saying we don't need to really sell oil in dollars anymore. Russia wants to sell its oil and natural gas in ruble or yuan. I mean, is that part of the trend of going away from the dollar, that people just don't need to trade in it or won't trade in it? Is that what you're saying? That's going to spark?
Yes, that's part of the pattern that's developing. And you see the dollar coming under very heavy selling pressure. Nobody wanting to hold the dollar. There'd be flight from the dollar, both foreigners and also domestic people who want to preserve the purchasing power of their assets.
Is this the reason why gold? And I know you're like gold. I think you like gold only because there's nothing else there. I mean, all the paper assets don't look good. But is this why gold's had this little run up here in the last few weeks? It went from $12.50 to 13 something, 13 and change, $13.30, $40 $1,340. Is this the front running of that? This is not going to be good. We're going to start moving into gold, or is that just the normal fluctuation in the gold market? Explain the gold market and where you see it going.
Well, negative prospects for the dollar, fears of rising inflation would all be factors behind that. You've also had some mounting political tensions in the rest of the world, which will tend to cause some flight to safety into gold, as opposed to the U.S. dollar, which in the past might have been a traditional was a traditional safe haven instrument. We have a circumstance now, if you look at it over time, gold has been very volatile. It hit a peak in 2011. It's down maybe 30% from that peak. But if you go back to the end of 1999, I looked at the returns here so far this century and more currently, just in the year to date. Gold has been up over 360% so far this century. You take the Dow Jones Industrial Average, it's been up 42%. As it stands right now, it's only a percent off its all-time high, at least as of the end of last week. And that is, people say, at least I'm up 42%. That's good. But if you look at it net of inflation, and I'm talking the government's headline inflation number, not realistic inflation, but headline inflation number, the Dow's actually barely kept up with inflation and actually has been down slightly in year to date, despite being at or near all-time highs. You look at gold, you take out the inflation number, you're still up over 200% so far this century, and we've been up 10% so far this year. You're still up 6% year to date net of headline inflation. Inflation is, as it's reported by the government's understated significantly. Worst case scenario, up around 6-7 percentage points, and not too surprisingly, gold catches that difference. Gold preserves the purchasing power of assets over time. The stock market might, if people were using realistic inflation numbers and targets, but they're not. Again, the government has changed methodologies so that the CPI, as you look at it, no longer reflects the cost of maintaining a constant standard of living, and it doesn't reflect out-of-pocket expenses. It has very little bearing or relationship to common experience.
One last thing, you recently said in I think a Sprott, forum or interview that you thought gold would go at $100,000 an ounce. And on the face of it, it just sounds, outrageous. But I think please explain that, because what that tells me is the dollar's going to have zero purchasing power. I mean, if it's $100,000 an ounce, the dollar's gone. Is that what you meant by that?
Yeah, I'm not suggesting that gold gets up to $100,000 an ounce. You take your profits. This would be in a hyperinflation, which I'm looking to have evolve here. And at that point, you could see gold at $100,000 an ounce. You could see gold at $1 million an ounce. But it's not. You don't take your profits with that. All that reflects is what the purchasing power of the assets the dollar assets that you put into gold have become worth in gold versus what would have been lost in the purchasing power if you kept them in dollars. It's maintained the purchasing power. It's a store of wealth. I'm not looking at this to make big profits. I'm looking at this as a long-term hedge against high inflation to maintain the purchasing power of one's wealth and assets through a terrible currency crisis ahead.
So buying gold is less of a buy signal for gold and more of a sell signal for the dollar. Because I guess because when I heard that, I thought, wow, 100,000. Well, I guess if the dollar's not worth much, I mean, if Weimar Germany, I mean, here's your $100,000. It's a postage stamp now. So I mean, look at Zimbabwe. I mean, here's $1 trillion. It's to buy you a Coca-Cola. I mean, that's what you're telling. That's what you're saying. People can't fathom that the dollar is going to be that worthless. Is that what the point you're trying to make?
It's difficult for most people to think in those terms, but as the inflation starts to pick up, all of a sudden people will begin to understand what's happening with that. I'm not looking for day-to-day. I'm not a day-to-day forecaster in the markets. In terms of holding the precious metals, I'm looking at as a hedge against a horrendous currency disaster. It's not for day-to-day purposes, but you hold it through the crisis and come out so that your assets are preserved and they're liquid, and you'll probably have some of the greatest investment opportunities anyone's ever seen at that time.
And you like silver as well? Is that
yes,
another
supplement to gold? I view gold as the primary hedge, but silver is a very good hedge, similar characteristics, and it is in terms of having a small change. If you're looking to deal with an ounce of gold versus an ounce of silver, the silver gives you a smaller value for the weight. But you know that in advance, and if you're trading for things, an ounce of silver might be more useful than an ounce of gold, depending on what you're trading for.
Because it's a smaller increment. And I just want to close with this one thing. And in this chart, I mean, this picture's worth 1,000 words. I mean, here's your 2008 or the 7 peak, and then the 2008 to 2009, boom, and then your bottom bouncing scenario. But I want to focus on this right here. We're somewhere going to be coming down here. This chart's in your mind going to go down, down, down from here. Is that correct? Is that what you're forecasting? A big plunge?
Well, it depends how the dollar breaks. If indeed we get into the hyperinflation, as I'm looking for, that's going to go down, down, down. It's not going to recover. There's nothing, not in the near term. It's going to take a while for the economy to turn around. The underlying fundamentals have to turn around. The basic problem right now is that the average consumer does not have adequate liquidity to stay ahead of inflation. Lack of income growth, lack of available credit. It's a very difficult time. But if the consumer can't buy goods at a rate that beats inflation, there's no way you can have positive growth in the GDP. I think two-thirds of the economy are based on the consumer.
John Williams, shadowstats.com. I like to say the real numbers, the real analysis. And I know you sell your work to big hedge funds and big companies. I know your list is secret, but you have very big players in the industry who read your work and buy your work. And I really thank you for revealing some of your thoughts and research and analysis here today on USA Watchdog for the folks here who come to the site. Thank you so much, John Williams, shadowstats.com.
Thank you for having me, Greg.